These presentations will work a comprehensive bookkeeping problem both within Excel as well as within QuickBooks. Excel having the advantages of being able to see all the components and how all those components fit together to make the end product, that end product, the financial statements. QuickBooks having the advantage of being able to use forms, simple data input, and an automated system in order to convert that simple data input into the end product, the financial statements. We will work each component of the problem in Excel first and then work that same information in QuickBooks. Hello, in this presentation we will enter an adjusting entry related to the short-term portion of a loan payable. This is the second adjusting entry related to the short-term portion of a loan payable we will be entering into our bookkeeping problem in Excel, keeping in mind how that same information could be input into accounting software such as QuickBooks. If you would like more information about the QuickBooks Pro, take a look at our comprehensive course in the link below. We're first going to take a quick look at QuickBooks and then jump over to Excel and enter this into our worksheet. When considering QuickBooks, this is going to be similar to the general ledger. This is a transactions by account report, and this is for the loans payable. And we currently see that we have this $72,000. That's going to make up the current loan that we have. We made a couple payments on that, and we also had this other loan we dealt with last time as part of the detail in our loans payable account. We're going to be dealing with this $72,000 loan at this time, breaking out the short-term and long-term portion. In order to do that, we need something like an amortization table. We'll take a quick look at what an amortization table is, where do you get it, how does it get put together, and then we'll use that in order to report or record our transaction, breaking out short-term and long-term portion. The short-term portion, in essence, being what is due within a year's time period. Once we know that, we can just make an adjusting entry. Typically, even in QuickBooks or accounting software, we usually do adjusting entries in terms of journal entries using debits and credits. However, it is possible within QuickBooks to use registers to enter the adjusting entries and enter most types of entries in a way to try to not use debits and credits. Debits and credits would be easier to use if we understood the debits and credits. So that's what we will use in our Excel worksheet. We'll go through the debits and credits and enter that now. Here we are in our Excel worksheet. We're in the Adjusting Entries tabs. Remember, this is going to be a bit different than us entering normal journal entries. We're going through the adjusting entry process where we're going to have a similar general journal, the general adjusting entry journal. And then we have the unadjusted trial balance. We're just going to post those entries rather than to the general ledger to this adjusting worksheet, this column here, to give us our quick adjusted worksheet column. Great worksheet to use when we're not seeing too many accounts, so we can see the detail right away, and that's a great benefit. We're going to make this as of the end of the month, 2/28. That's when this journal entry will be as are most of the end of period adjustments will be made as of the last date of the month or time period. As we saw last time, we broke out the short-term portion of a $5,000 loan, which was included in this loan balance here. So this $74,878 included two loans. One was a $5,000 loan, all short-term, which we removed from this account now and put into the current portion because it's all due within a year's time. We're going to do the long-term portion now and look at its loan type. So there's going to be something happening between this account and this account. These are the loans that we are looking at, or the two accounts we are looking at. We want to break out that short-term portion, that portion that's going to be due within a year and needs to be in the current assets section of our financial statements. To do that, we can look at the general ledger, and all we did was pull over the general ledger to analyze it from our worksheet, and we see that we had this 22 and this 50 adding up to this 72,000. That we're going to say is all one loan. That's going to be one of the loans we have included in this account. The second loan was this 5,000 that was included in this account. We're going to be dealing now with this loan and breaking out the short-term and long-term portion. Unlike the 5,000, which was all short-term, it was all something that was due within a year. This loan will have a short-term and a long-term portion. Only way to break that out is to see the amortization table. We won't make the amortization table again because we did that prior. But here is the amortization table. We made this amortization table when we were calculating the interest to record the interest on a payment. And we calculated this amortization table for the short $5,000 loan in a prior presentation in terms of the adjusting entry process. And we could just take a look at this amortization table then and use it. Note that when we're considering a loan and you're doing these adjusting entries, then you may not have the amortization table in the loan. The loan may just give you the terms, and then you'd have to somehow build the amortization table. So we could, if we have this, just to look at this table, we've got the loan at $72,000. We're saying it's going to have 60 payments, so that's going to be 5 years. The rate is 5%, and we're going to say the payments are $1,359. This is usually known within the loan. If we look at the loan, we have this information there. What we don't often have, or we may not often have, is the table showing out the breakout between the payment amount between interest and principal. And this is going to be a typical loan. We pay it each month, and we need to break out the loan payment between interest and principal. And when considering the short-term and long-term portion here, you would think that we would just say, how much is going to be due within a year's time period? Well, we're going to make payments of $1,359 each month, and 12 months is going to be 1 year. So we should be able to multiply that times 12 and say that $16,308 would be short-term, and the rest would be long-term. But that's not going to be the case because part of that short-term portion is interest. And the interest we can't include as short-term because we haven't incurred it yet. Interest, although we plan on paying it in the future, hasn't been something that we owe as of the point in time we're making the financial statements because we haven't yet used the money. That would be like paying, saying we're going to pay rent next year and putting it on the books as a liability this year because we plan on using the facilities next year to do our business within. We can't record the fact that we owe rent on the facilities when we haven't yet used the facility. So that's the same thing we're going to do here. We can't record the interest that we're going to incur as we use this loan, $72,000, for a time period that we haven't yet used it for. So therefore, since this payment breaks out between the interest and the principal, we got to break out just the principal portion of the loan, and that's what we are going to pay back in terms of what is owed as of this point in time and what we will pay back within a 12-month time period. Now let's take a look at the amortization table. The amortization table, we started with this $72,000. We made this first payment. The first payment was for this amount. The interest was $300, and that means the principal reduction was this minus the $300, bringing the balance down from $72,000 down to $70,941. Then we made this payment. Same concept, interest and principal, although they're a bit different. Breakout between the same payment amount brings us to a principal balance here. This is the principal balance that's currently in our account here. So we removed this $5,000. So in the general ledger, we're left with this amount here, this $69,879. That's how much we owe in total as of this point in time, as of the second month, as of February. So this is our balance at this time. This was the original balance. We made 2 payments. This is our current balance at this point. So what we need to do now is take this current balance and break out the current portion and the long-term portion. To do that, all we need to do is see the principal portion of the payment in our amortization schedule. Now note that the amortization schedule, if it's working, there's 60 payments, 1 down to 60, and the principal goes down with each payment. After 60 payments, it will be down to, if we scroll all the way down, scrolling down to 0. And the interest is going down, whereas the principal portion of each payment is going up. So if we scroll back up and we have this amortization table, we can figure out how much principal payment will be paid within a year's time period. We cannot do that without an amortization table. We can't really do that with a calculation such as this. So we really kind of need the amortization table to do this process. So we're going to say that these are the principal payments. So I'm just going to count out 12 of them. We're going to make a payment of this, and this is the amount that's principal, and then this is the amounts of principal in the next payment, 2, 3, 4, 5, 6, 7. Let's do that again. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So these are going to be them. I'm going to highlight those. I'm going to right-click those and make them yellow. those are going to be the 12 principal payments we will have. I'm just going to add those up. If we highlight this, adds up to 13,109. That's what we're going to put here. I'm just going to put this is going to be the short-term portion equals the sum, double-clicking the sum function of these yellow items. Those are them, tab, and that's going to be the short-term portion. I'll make that yellow, right-click and make that yellow. If that's the short-term portion, then the difference between what we are currently at and the short-term portion will be the long-term portion. So in other words, the long-term portion is going to be this, the total we're at right now, minus the current portion. So this is current, long-term, total. And then the total, I'll sum those back up, equals the sum of these two. So there's the original total here. So this long-term portion can also be found there because that's where we will be at this point in time. After we record these amount of payments, we'll be here after 12 months time period. That's where we will be at. So that means that we need to make an adjustment for that 13,109. We need to take it out of the long-term portion where it's currently at, put it into the current portion. That's what we'll do now in our journal entry. Once we do that, we will end up with current portion increasing by that. It already has 5,000 in it plus the 5,000, and the long-term portion being this amount. Let's do that now. Scrolling back to the left, and we're going to make our adjusting entry. It's going to be as of 2/28. We will be dealing with these two accounts, the loan payable current, loan payable long term. We currently have, after that last entry, the 69,878, and we are going to make that go down in the long-term portion by the current portion of the long-term loan. So in order to do that, we're going to do the opposite thing to it, which in this case is a debit. So we're going to copy this cell, loan payable long-term, put that in B6, right-click and paste 123. The amount then is going to be 13,109. Going to make the cell a bit larger so that we can see that. So there we have it. Then we're going to credit something for the same amount. I'm going to put negative of that number. There's the 13,109 that we will now put into the current portion. This is a credit. We're going to increase it by doing the same thing to it, which is another credit. So I'm going to put my cursor on loan payable, right click and copy. Put that on B7, right click and paste 123. Then we're going to increase the indentation. We're going to go to the Home tab, Alignment Group, increase the indentation, and there's our adjusting journal entry. Now we'll post this out and see if it does what we believe it should do. So we'll first post this loan payable long term to our center column here. So it's already 5,000 in it. So we're going to double click on it and then add something to it. So there's 5,000 in it. I'm going to double click on it. And if I scroll up, it's picking up that number. So it's already equaling C3. After the 3, we're going to say plus, and then we're going to point to this number, which is C6. So within this cell, it should say equals C3 plus C6, and that will make this amount go down by that 13,109 to 56,769. We are now out of balance by the 13,109. We're going to record the second portion then in the current portion here. So that's going to be going here in M14. There's already something in it. So once again, we're going to double click on it. It's already picking up D4. We're going to go to the end of D4 and say plus, and then point to this 13,109, which is going to bring this 5,000 up by 13,109 to 18,109. So there's the 18,109, and that brings us back in balance down here. No effect on net income from this adjusting journal entry. All we're doing is breaking out the current portion and the long-term portion. Let's see if these amounts make sense in accordance to our amortization table. So we have here we've got the 5,000, that's all short-term. So the short-term portion should be the current portion here, all the yellow items, plus 5,000 because there's two loans. It should be this and that 5,000, 18,109. That's our current portion. If we scroll back over here, we have 18,109. The long-term portion should be the 56,769. That's going to be the long term, here's where we started at minus the current portion. There's the long term, 56,770. It's off by $1, so that's going to be a rounding difference. And we also see, of course, that amount here on our amortization table. That's where we will be at the end of a year's time period. That's what will be due at the end of a year's time period. Hello. In this presentation, we will break out the short-term portion of a loan payable within QuickBooks Pro 2018. Last time we looked at a loan payable where we had to reclassify it from a long-term to a short-term loan payable. This time we will take a loan payable that has a short-term and a long-term portion, look at the amortization schedule, break out the short-term portion, give some reasoning as to why to do that, how to do that in terms of the amortization schedule, and as well as how to technically do it in the QuickBooks software system. If you've been continuing along with us, we will be working with the Get Great Guitars problem. If not, that is okay. We will be doing adjusting interest entries within QuickBooks, breaking out the short-term and long-term portion of a loan. If you have the backup file to this point, you can restore it by going to File, Open, and Restore the backup file. If not, that's okay. If we do have the Open Windows tab open, in order to open the Open Windows tab, go to View, Open Windows List. We only have the Home tab open. To have the Home tab open, we want to go to Company and Home tab. What we're going to do is break out current and long-term portions of a loan. In order to do that, we are first going to look at the report for the balance sheet. So we'll go to Reports up top. Scroll down to Company and Financial. Scroll down to the Balance Sheet Standard. And we're going to change the dates up top in the Customize Reports. And we're going to have the range be 01/01/21, January 1st, 2021 to 02/28/21. This will be the time frame that our problem is working in. And then we're going to select OK. And here is our information. If we scroll down to the liabilities, we see last time we broke out the current portion of one of our loans being a short-term loan, and we had to pull the whole amount out of where the loan payable account was set up to this short-term loan payable. This time, we're going to take the rest of this long-term loan payable, and break it out between a short-term and long-term portion based on how much of the principal payments are going to be due within a 12-month period. So if we double click on this item, we see the loan was 22 and then 50. The loan was at 72,000, and then during the year we made these two payments on the loan in accordance with the amortization table, decreasing these amounts in accordance with the amortization table. What we will do now is look at this balance, look at the amortization table, and see how much of it is current versus long-term. This is something required if we were to issue the reports to externally typically, because it would be generally accepted accounting principles to have the short-term and long-term payments. It's also really useful when we're looking at the financial statements to know how much is going to be due currently and compare that to our current assets, whether we have enough cash to pay for those current liabilities. When we do this in practice too, remember that we are going to put everything into a current portion and a long-term portion, one grouping of accounts. If we have a lot of loans, more than one or two loans, we might want to actually break out each individual account that is a loan account, and that might make it easier to track. However, within the reporting of the financial statements, we typically just need that current portion breakout and the long-term portion breakout. So we're going to have those two accounts here, a current portion and a long-term portion, and break out whatever loans. We only have two loans within those two current and long-term portions. If you have a lot of loans, you might want to put one separate account for each loan and then a separate short-term and a separate long-term portion. There's a couple different ways you can format this out. Clearly, if we're making loan payments, however, that have an interest and principal portion, it's not typically efficient for us to break out the short-term and long-term portion at each payment date, meaning each payment we make, it might not be efficient for us to break out the long-term and short-term portion because it'll differ as we go. So what we want to do is do these adjusting entries periodically at a point in time when it makes sense, when we're really analyzing the financial statements or distributing financial statements to external users. That's when we want to make these adjusting entries and make sure they have been input. Also note that we are putting these entries in net of interest. So if you double click on these entries, we can see that they're being put in according to the amortization table, meaning they have an interest portion and a loan payable portion. We could also even set up a system in which we do the interest portion at the end of the time period as part of the adjusting journal entry. We'll talk more about that in a bit. What we'll do now is just break out the long-term and short-term portion, first looking at our amortization table and getting an idea of what that is and how to make sense of it. So I'm going to close this back out. We're going to take a look at the amortization table. Here is the amortization table, and so we have the loan amount, the payments, 60, so it's going to be 5 years, and then we have the rate, 5%, and the payment. This loan is going to be set up as kind of, we might be familiar with like a mortgage type of loan, or typically kind of payments for auto payments or something like for financed a car or something like that, where we have both a principal and interest portion and the payment is constant. So the payment remains constant, however, the application between interest and principals varies as the number of payments go. As the principal amount declines, the amount allocated to interest of the same payment goes down, the amount allocated to principal goes up. So that means that it's going to go down, but not at the principal portion will go down with each payment, but not at a constant rate until the end of the 60 payment, where we will be at 0. When breaking out the current portion and long-term portion of a loan like this, it's a little bit confusing because we know that we have a loan balance here. If we look at our activity, back to QuickBooks, we made 2 payments on this loan. So we made payment 1 and payment 2. So we are at the balance after that second payment. If we go back to the amortization table, we should be at the balance right here. So we're going to go ahead and highlight that. I'm going to highlight that, and that's where our principal balance is. The 69,878 back to QuickBooks is equivalent to this 69,878 right there, and it's our ending balance 69,878. Now, of that amount, we need to determine, back to the amortization schedule, we need to determine how much is current and how much is long term. In order to do that, we need the amortization schedule. We cannot just take the payments and say, well, 12 months of it is current. Current means, by definition, what we owe in the next 12 months. And the logical thing to do then would be to say, well, we have payments of that times 12 would give us 16,305 would be the current portion, and then the rest would be long term. That would be a reasonable assumption. However, it's not correct because this 1359 includes the interest portion, which has not yet happened. So that would be like recording the interest expense on a rental apartment or a rental office before we actually lived in it, knowing that we're going to pay rent in the future, and therefore recording the fact that we have that current liability now, even though we haven't lived in it yet. So that's the same kind of thing is happening. We can't include these interest payments in the current portion because we haven't used the money to help us generate revenue, and therefore we don't technically owe it yet. So what we have to do is find just the current portion of the principal payments, and so we need this amortization schedule to do that. So the payments that are going to be due in the next year are going to be this one: 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. There's a year. If we highlight that, that's going to be our year's worth of amortization portion of our payments. So here's our payments each time. The interest changes each time, therefore the amount of principal changes each time. And so what we're going to do is we're going to say the current portion is going to be all of these principal portions for the next 12 months. Those are going to be the current portion. And if we then say that this is where we're at, let's bring this, I'm going to bring this up to here. All this is the sum of the yellow items, the current portion. So we're going to say that if this is the total loan minus the current portion, this will be the long-term portion. In other words, after we make 12 months of payments, we make all these payments with the interest and then the principal going down by this column. we will be at 56,770, 56,770. So that's our ending, that's our long-term portion. So in essence, our journal entry will be then, for this 13,109, decreasing the long-term loan payable and increasing the short-term portion, decreasing the long-term portion to 56,770 and recording the short-term portion at 13,109. That's going to be our adjusting entry. So let's go back to, well, I'll keep this here. Let's go back to QuickBooks and make that adjusting entry. We're going to go QuickBooks. Now, in order to do that, let's close this back out and go back to the balance sheet. So the balance sheet is currently open. Typically, the normal way to do that is to go to banking and go to, go to company and go to adjusting journal entries, make adjusting journal entries. But we would need to know debits and credits in order to do that. So we'd have to debit the long-term note and credit, debit the short-term note payable and credit the long-term note payable. If we want to do that without debits and credits, we could use the registers, and that's what we'll work with here. In order to use the registers, we can just go to the banking and we can scroll down to use register. So we'll actually be able to enter these adjusting entries without knowing debits and credits, and we'll just say use register. And like the checking account, every account has a register. So we're going to scroll down to the register for loan payable. We'll use the current portion. Make sure you know which one you're in, current versus long term. And we're going to go to the current side and say OK. And we know that the current portion needs to increase by the amount that's going into the current portion. So we're going to have the date at the end of the time period, 2/28, and we're going to increase it by the current portion according to our amortization table, which is 13,109. So we're just going to put in the current side, 13,109, and then the other account is going to be the long-term side. So the long-term loan payable, if we scroll up, we got loan payable current, and then just loan payable long-term is the account type. That's the one. So by doing this, we're going to increase the current account we are in, the register we're in, long-term loan payable current, and then it's going to decrease the other account we're assigning to, which is the loan payable. So we're going to select enter. And then when we go to the balance sheet, make sure you select enter, by the way, or else it won't record that. And then we're going to go to the balance sheet. And we can see that the current portion now at 19,109. If we double click on that, we see the 13,109 here. Double clicking on that, there's that amount. So closing this back out, the current portion of our loan payable now includes two loans. One, the 13,109, which is the current portion of our long-term loan, and then the 5,000, which is just a current loan. And that matches what we have here, 13,109 in our amortization table. And the other loan, of course, the entire principal amount of 5,000 there as well. Back to this, close in that. If we close this back out and then go to the long-term portion, here's the long-term portion, 56,756. Double clicking on that, we see our activity. There's the adjusting entry we just made. Double clicking on that, there's the amount. If we close this back out, we say there's that 13,109. That matches this amount here, our adjustment. What's left? 56,769, which is our long-term portion we see here, or we see it after the 12 months of payment. After we make these 12 payments, that will be the balance a year from now, the full balance a year from now. In other words, that's why it's the short term, that's why it's the long term portion, because it's where we will be at after a year of the short term payments of 13,109.